My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey kids, welcome back. Today our special guest, Nic DeAngelo, is zooming in from a beautiful part of the country. He is in Southern California. We're doing this episode towards the end of July, so you're probably cooking your butt off there, Nic. Warm times, that's for sure. And Nic is a very experienced multifamily real estate investor, very, very experienced capital raiser. He's doing something slightly different, quite a bit different than a lot of other syndicators and capital raisers. He's got a fixed fund. So we'll be talking about that. So Nic, welcome to the show. Great to have you.
Dave, it's great to be here. Great catching up with you beforehand. And yeah, I'm excited to jump in on some fun stuff today.
So give us a little snapshot of what your company does, Saint Investment, what the portfolio looks like as of the middle of 2025, like what asset classes you focus on, what locations, that sort of thing.
Sure. So my initial background was working with a couple family offices very early on. So I had the benefit of working with talent that has seen the evolution of real estate investing for multiple generations. So I was blessed to be in close. What I learned and my big takeaway was think long-term. That's the big takeaway. Think long-term.
A lot of people forgot that the last few years, didn't they?
Oh my gosh, look at the stock market, Dave. It's painful to see some of the fundamentals there. But the big takeaway was think long-term. And so we've done, 19 syndications. We're very proud of that. We've had great returns along the way, lots of happy investors. But what we started seeing was a big shift, especially here in the US, especially working with high net worths. They were looking at the chaos in the markets, the chaos in the US government, the chaos with our currency, chaos with inflation, and they wanted something stable. So we were tasked with people that we had huge respect for, that were large investors, to find something that could be a multi-decade thought process, a multi-decade investable asset class. And so we really dove in on the economics of this. I had been investing in mortgages, single-family mortgages, for a period of time. I'm historically a distressed assets buyer. That was my acquisition model. And so inevitably, when we were buying from banks, they would offer us to buy these mortgages. We typically said no thanks early on. Eventually, we saw the value in those because they have, in the US, we have this unique system where we have 30-year fixed rate mortgages, unlike anything else in the world. So eventually, we found that to be a very unique system, very standardized pay scale. We could count on the payments we were getting every month. And then the US housing market just got more and more and more entrenched. So we had more and more faith in it along the way. So what we ended up doing was putting together a fund of mortgages based on single family homes in the US, paying a high, very competitive return of 12 to 14%. And then most importantly, thinking long-term about that investment class so that our investors could be getting cash flow or compounding investments for a long period of time. So that's what we do today, our fixed income fund.
Got it. All right. So so you're not really into the multifamily anymore. Do you still have some properties in the portfolio, or have you completely exited all of your multifamily?
So we're not in multifamily today. Our biggest focus on the syndication side historically has been industrial. So we still have 12. We still have 12 properties in the portfolio today. Very happy with the returns. Very happy with the performance on those. But we are through and through industrial investors primarily on the syndication side. The huge push in the US to bring manufacturing back home has only bolstered those over time. And so between those two asset classes, single family mortgages and then industrial real estate in the US, we are very happy with being situated in those.
But at this particular time, Nic, you're going all in on the note business. Is that what I'm understanding?
Exactly right. Exactly right. I think industrial timing is much more finicky because you're typically leasing to one tenant for 5 years. So you want to not be too early to that, or you're going to be under market for 5 years. So we're waiting out the cycle a little bit. I think probably by the end of this year, we'll be back in industrial.
All right. So let's back up for a second here, Nic, and maybe explain to folks, myself included, how the mortgage, the residential mortgage business, the note business works, and then how you kind of roll that into this fund and make it appealing for everybody so that you know, you're doing what you want to do, your investors are making a good return, and just kind of how this, you know, what the exit strategy is and how you're generating the income from that.
Absolutely. So when you think of the mortgage market, let's start at the top. You have these large banks, and their job is to generate loans, simply put, right? So when you think about that in mass or at scale, they're originators. They want to create these mortgages, right? They're also
Mhm.
held to these very high standards by very large government agencies, the Comptroller of Currencies, the Federal Reserve, et cetera, dozens of agencies that overlap with these banks. So the highest use of their time is to originate mortgages, create mortgages. So they get in a pickle because what happens when they create 10,000, 20,000, 100,000 mortgages, they want to package those mortgages off and sell them to other large institutions, Blackstone, et cetera. The problem
Right.
is when they have non-payers in there, then what happens is those go in a different bucket. Those over time that builds on their side. These could be people that missed a couple months payment, or they're making their payments but missed 3 months for a period of time when they were furloughed during COVID, for instance.
Yeah.
So it makes more sense financially for them to sell those off at a discount than it does to sit there and try to work out every mortgage because they're so good at originating. They don't really want to focus on that side, that distraction. So we come in at that point. So Saint Investment Group would come in. We'd work with banks that we have long-standing relationships with. We buy those at a discount, right? Because they're non-performing or semi-non-performing. And then on the backside, we work with the homeowners to keep them in their homes, make it work for them on a new structure that would be something that they could commit to for a long period of time, and then that produces a pretty high return on the back end for a very long period of time. So that's the simplified version of what we do along the way.
Okay, now that clears a lot of things up. And then your goal is to bringing these mortgages up to speed, get the borrower back on track, making those payments on a regular basis. But instead of bundling those mortgages up and reselling them, you hold them long term in the fund. Am I understanding that part properly?
That's right. So there's a model where you fix and flip mortgages,
Yeah.
if you want to
Yeah.
think about it that way. That's not us. We think long term. We want more mortgages in the portfolio to bolster the income even more and create a long term cash flow situation. That's why an income fund model was the best model that we found at that time for that asset class.
Okay, so I'm curious, Nick. So how does that kind of work? What kind of volume of mortgages are you guys buying? When investors get involved in the fund, what does that look like from their side of things? Just kind of maybe walk me through that.
Sure. So we're evaluating deals all the way up to right now. We're in discussions on 185 million. Now we wouldn't take down all 185 million. We would take down a portion of it from that bank or
Are
regional
you
bank,
able
et
to kind of
cetera.
cherry pick the mortgages that you guys want? Is that what you
To a
do?
degree,
To
yeah.
a
I
degree,
mean,
yeah.
they might parcel it out into chunks, and
Hmm.
blah 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 group takes X, and we take Y, et cetera.
Hmm.
But at the end of the day, we're looking at very large deals, underwriting very large deals, and then at times we backfill, right? Maybe we need to place some capital. Maybe we buy 12 from the regional bank just to get them off the books, and we're getting a great price. So there's a wide range there, but typically we're looking to place, eight figures into deals because of the fact the pricing's better, the air's much thinner, so you're not bumping into as much competition. And with our relationships, that's kind of their expectation also. So we want to make
Right.
sure we're good partners along the way.
Very good. So then you take down a whole bunch of these mortgages. You must have a team that's working with the borrowers to kind of get them on track. What does that side of the business look like?
Sure. So we do have a team. That team is 100% contacting borrowers, working it out with them. And what that workout very commonly is, a good chunk of the time, is just getting a hold of people because they've been trained by these banks to not answer the phone and not
Yeah.
return letters and not return email. So a lot of it's just saying, hey, we're here to help. We don't want to do this foreclosure thing, although that is what's starting right now. Our
Mhm.
goal is to keep you in your home. Our average LTV is about 50%. So they have a lot to lose. And in the US, with homes going up so consistently and such a huge gain, especially in the last 5 years, it's really a good time for them to play nice on their side. We play nice on our side, and they get to stay in their homes and make a loan modification that works out for them. So that's our goal. There are
Right.
groups that go to market with the expectation of foreclosure. That's not where we're at. But loan modifications typically include adjusting the interest rate higher, extending the mortgage so that their payment goes lower, et cetera. So there's some big modifications in there, but as the conversation unravels, they know we want to keep them in the home. They know we're not coming after their equity. We want to keep them in a stabilized situation so they get to enjoy their house. So for them, once they understand that, it's a win, right? They understand that we all have the same objectives the majority of the time.
Very good. Okay, that makes sense. So then from your investor's point of view, who is typically investing in the fund? How much are they investing? What are they looking for? What are you offering those guys?
Sure. So we typically lean very heavily towards people that are moving towards retirement, in retirement, or large business owners. Those are kind of our three big categories. So very high net worth across the board for
Mhm.
the reason that one, it's not that complicated. They get the simplicity of it. It's something that they understand the nuts and bolts of. Two, it's not a huge gamble. When we're talking an average LTV of 50%, right? In US history, we've never seen that. Maybe minor markets, but we invest in over 29 states. So it's pretty spread out. Maybe if you
Yeah.
take Las Vegas at its worst, it would get close to that. And then three, for the fact that it's fixed, right? We're not saying, hey, hope we do well, guys. Hope it all works out, right? They know what they can count on month after month. So for those reasons, we typically deal with those higher net worth individuals, typically in retirement or approaching retirement, or large business owners that are too damn busy to be dealing with the weeds, but they all across the board, they still want above market return, right? But something not that's not crazy, that's not tied to market conditions that could get out of whack.
Okay. So what's typically the minimum investment that you're looking for in the fund?
Our average is about 200, 250. It kind of bounces between the two, but our minimum is only 50,000.
Hmm.
So, if somebody's really hung up on it, we're just like, try us out for 50 grand. You'll like our reporting, you'll like what we do, and we're going to call you in 3 months to bump you back up, right? Because you got to get that reinvestment and make sure that you tested us out. Now let's, grow the relationship. But that's very, 2 to 250 is our average, and then 50,000 is our minimum.
So when did you start or kind of restart the whole note business, the mortgage business and the fund? How long has that been going on for, Nick?
So I've been doing mortgages for going on close to 15 years. So all the way back to, kind of around the crisis era in the US, the global financial crisis and the global financial crash. But our fund is newer, last handful of years. So it's a newer
Okay.
fund on that side.
And at the moment, how much do you have under management in the fund right now?
Sure. So because there's not as much leverage, we're a low leverage fund, so we don't get to
Mhm.
brag about insane numbers like you see a lot of AUMs thrown around like a billion. We're about 60 plus million equity under management in the fund
Mhm.
today. So not a small fund, not definitely not a huge fund, and we use pretty low leverage, so our assets under management are only maybe around the 80 mark.
Okay, very good. And Nick, I mean, obviously you're a big proponent of this. You've been doing this for a long time. It's not all sunshine and flowers. What's the downside to the business and this kind of real estate investment with notes?
So the other half of the coin of it being fixed is that there's not an upside component, right? So this is a fixed return structure.
Hmm.
So for instance, we had a lot of entrepreneurs that found us at a different point of time. We were kind of targeting them with some different branding and marketing, and they were appalled that there was no upside component. What do you mean I'm not getting 25% and that a piece of the returns and et cetera? We said, guys, this is a fixed income fund. If we wanted to push returns, we have a syndication model that's coming up, down the road, et cetera. So the downside of it is that one, there's no upside component. We know what we're getting, so we can give what we're giving, 12 to 14 plus percent. But the downside is there's not an upside component. There's not a carried interest. There's not a performance, back end on it. That said, the other side, there's not a tax benefit. So this is great for IRAs. That's like a huge component is that they're already getting the tax advantages of an IRA, so they go in
Right.
with that in mind. If somebody was saying, "Hey, I want to take advantage of a 100% bonus depreciation, this is a tax play," I'd say go to a syndication. It's just not a
Hmm.
fit for that individual. But if somebody's looking for something consistent, this is a great model.
And then from your point of view as the operator of all of this, what's kind of the biggest hassle for you guys and your team connecting with the borrowers and getting them back on track? I would imagine. Is there anything else that's like a real challenge in the business?
The big notes that I'd have are one, underwriting on this is insane, Dave.
Mm.
Underwriting on this is insane. You're going line by line. Our underwriting process is ridiculous. It's huge spreadsheets, hundreds and hundreds of lines at a time. You're pulling title report. I mean, it is a very advanced process, and you have to do it for every single one, right? So you have to check your boxes so you're not getting hosed on deals and making sure it is what you expect it to be. That's
Mhm.
one. Two, there's a constant paperwork shuffle. There's a lot of opinions. People think, well, I haven't heard from the bank in 5 years, so then it doesn't count, right? Stuff like that. You have all kinds of crazy discussions. I'm getting,
Yeah.
emails this morning about one where I said, where the opinion of the borrower was, well, I hadn't heard from the original bank, so you don't count. I was like, well, we bought the debt. We're here to help. We're trying to help. So let's move past the whole you don't have to pay the mortgage back and let's start working together and getting you on track. So there's a lot of things like that. There's the paperwork component, the due diligence component, the people component, which can
Yeah.
never be understated, right? Or overstated, right? And so it's a lot of moving pieces that requires a machine behind it, but it's backed by such a rock solid asset class that it
Yeah.
makes it all worth it, right? It doesn't
Yeah.
deal with the same issues that some other asset classes have right now.
Hey there, if you're a capital raiser, a syndicator, or a fund manager, and you're looking for a steady flow of incoming accredited investor leads, then go ahead, grab a free copy of my new book, How to Get 20 Accredited Investor Meetings Every Month Without Cold Calling, Networking, or Chasing People. You can get that at 20accreditedinvestorsbook.com. Again, that's the number 20accreditedinvestorsbook.com. So one of the things you become very good at, Nick, is bringing investors on board, raising capital. So with this model, what are you finding works best for you guys besides word of mouth and referrals, obviously, for bringing in new blood as far as like investors into the fund?
Sure. So you're saying lead generation, I'm assuming,
Yeah,
right? Bringing in the
investor
new
lead
leads. Yeah.
generation these days. Yeah,
So we do a few different models. The number one, the absolute number one best starting place is figure out your product and who it fits with, right? Most people have a unique advantage. I grew up with boomers as some of my closest friends, my mentors, the family offices. I worked very closely with the boomer kind of patriarch of that family. So I really enjoy working with boomers, and I've gotten to hear, their concerns over the years. That's a unique advantage. Not a lot of
hmm
people have gotten that blessing to be able to do that. So if we take a conservative fund, it matches well with the archetype, and we have a kind of a unique advantage there. Then it's just getting to the right people, right?
yeah,
So we've found success in a few different categories. We've done everything from ads to cold email to even, SMS along the way. But our real draw has always just been, let's get back to adding value. So we do webinars. That's kind of our core concept. It's very informational, or often an hour and a half. They're very dense material, but they're topics not covered on the news. And because we're
mm,
typically dealing with an older audience, they're higher percentage of viewers for things like Fox News, MSNBC, CNN. So they don't hear about these topics in the way that we present them. They don't hear about some of the deep dive economics that we go into. So we try to give them a new perspective, try to give them as much information so they make the best decision on their side. So it's figuring out what your match is for your product and then who the right people are. How do you
yeah.
get to them? We use email, we use, things, and then how do we add value? It's through our webinars primarily.
Yeah, and the nice thing about the boomers is, and correct me if I'm wrong, I would imagine their attention span is more than 5 seconds.
That's
So,
right.
so they'll stick around for an hour, hour and a half, and probably interact and ask questions and all that kind of good stuff.
So I mean, that's right. And so
Yeah,
to take a deep dive like that, it probably isn't for the TikTok crowd, right? Maybe not even the Instagram crowd, but for people that really want deep insights and, a lot of layers peeled back on topics, there's a lot of value there.
nice, nice. That's very, very smart, Nick. Awesome. Well, hey, you know what? This has been great. If people would like to find out more about you and your company, what's the best thing they can do?
So we give away a ton of information for free, our webinars, different, reports that we put together, economic trackers, et cetera. They can find all that for free at saintinvestment.com/resources. And they can find info on that page too, if they want to learn more about investing with us.
Perfect. Nic, thanks very much for being on the show.
Dave, I had a lot of fun with you. It's great catching up with you.
Likewise. All right, everybody, take care. We'll see you on the next one. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.